Hello students, welcome back. This is Dr. Mercado. Welcome to Accounting 2302, Managerial Accounting. In this lecture, we are going to be covering problem 23-1A. Very important problem dealing with variance analysis. Now, before we begin, I do want to encourage all students to ensure that you read the chapter before you begin working on your homework problems. Okay, I would say all of the information that you need to complete your homework assignments is in your ebook. Okay, so please take the time to read the chapter before you begin working on any of your homework. Also, when you are working on a specific problem, identify the section of the ebook that pertains to that problem. That way, you can go back and review that information in detail and then be able to apply it to the specific problem. Okay, so having said that, the problem that we're going to be looking at today is problem 23-1A. It deals with direct materials and direct labor variance analysis. Okay, so there's a lot of formulas that are going to be applied in this problem, but do not worry. All of the formulas that you need are in your ebook. It's just a matter of reading the ebook. Everything is there. The formula is provided, and the description of what we're doing is also included on your ebook. So make sure that you do read. That is why it's so important. Okay, so let's review the problem that we're going to be tackling today. So it says Jericho Fixture Company manufactures faucets in a small manufacturing facility. The faucets are made from brass. Manufacturing has 45 employees. Each employee presently provides 38 hours of labor per week. So we have 45 employees and they work 38 hours a week. Make a note of that. Information about a production week is as follows. So we have the standard number of pounds of brass, 0.4 pounds. That is per faucet. The standard price per pound of brass, 80 cents. The standard wage rate per hour. So we pay each of our employees $21 an hour. That's the standard wage. Our standard labor time per faucet is 15 minutes. So it takes about 15 minutes to be able to make each of the faucets. And then comes the actual numbers that came in. The standard is our estimates. This is what we're estimating it's going to cost us to make the faucets, how long it's going to take us, how long we're going to pay for employment, all of that. So standard is our estimates. Then the actual numbers come in. So we have the actual price per pound of brass, 90 cents. The actual pounds of brass used during the week, 4,500 pounds. The number of faucets produced during the week, 10,000. The actual wage per hour is $22, and the actual hours for the week, that's 1710. So that's the number of actual hours that were worked during the week. Okay, and they got that by getting the 45 employees times the 38 hours. Okay, so our instructions are to determine the standard cost per unit for direct materials and direct labor, the direct materials price variance, direct materials quantity variance, and total direct material cost variance. And letter C, the direct labor rate variance, direct labor time variance, and total direct labor cost variance. Okay, so as you can see, we're going to be doing a lot of variance analysis. I have already pre-entered the formulas. So what I basically did is I copied and pasted the formulas. Now you notice I have two sections. I have a section for materials and I have a section for labor. Okay, if you go to your ebook, you will find that information on your ebook. Okay, so you have your direct materials price variance, the formula is right there. Your direct materials quantity variance, the formula is right there. And then we go to your direct labor rate variance, the formula is right there. And your direct labor time variance. Now, to calculate the direct materials and direct labor cost variance, you need to calculate these two formulas first and then apply it over here to your direct materials cost variance and your total direct labor cost variance. If you calculate either of those two formulas incorrect, then your calculation over here is also going to be off. Okay, so you have to get your direct materials price variance, your direct materials quantity variance. Once you get those two numbers, you apply it to your total direct material cost variance, which is your direct materials price variance, whatever you calculate here, plus your direct materials quantity variance, and that will give you the amount of your total direct material cost variance. The same thing for labor. You calculate your direct labor rate variance and your direct labor time variance. You add the two, and that will give you your total direct labor cost variance. Okay, so I'm not going to read all of this, you all can go back and review your ebook, look over the formulas. All I did over here on my spreadsheet was copy the formulas directly from right here, from your ebook. That's all I did. I just transferred them over. That way I could have the information easily available. Okay, so nothing extra has been done. I just copied and pasted. Okay, so let's begin with the first requirement. It says calculate the standard cost per unit for direct materials and direct labor. So we want to know the standard cost. How much are we anticipating spending in labor and materials to make a faucet? One faucet, okay? So let's start off with direct materials, okay? So according to the problem, it is going to take us 0.4 pounds of brass to make one faucet, okay? And it is going to take me, the cost of that 0.4 pounds of brass is going to cost me 80 cents, okay? So what are we going to do? We're going to get the 80 cents and we're going to multiply by the quantity of brass that we need, and we need 0.4 pounds. So I'm going to go ahead and put it in the formula, 0.80 times 0.4, and that gives me 32 cents of materials, that is your brass that you need, per faucet, okay? So the materials is not that expensive. Now let's look at the labor, okay? Now for the labor, it says that I am going to be paying my employees, the standard wage per hour is $21, okay? And it takes my employees 15 minutes to make one faucet, okay? So my standard hourly rate is $21, okay? I'm going to multiply that, okay, by, and I'm going to get the 15 minutes, and I'm going to divide it by 60 minutes. Why? Because I'm only interested in those 15 minutes, okay? So let's see what that gives us, okay? So if we do, let me see if it works here, 15 divided by 60. Let me do that first, the calculation, and then I multiply by the $21. That gives me $5.25. So my labor is more expensive than my materials. So to manufacture one faucet, I am estimating, because this is the standard, okay? This is not the actual amount. I am estimating that I'm going to spend about $5.57 per faucet, okay? In materials and in labor, okay? So that is requirement A, okay? Let me put this here. Okay, so now we're going to move on to materials, okay? So I'm going to move it a little bit up, okay? So for B, we're going to calculate the direct materials price variance, direct materials quantity variance, and the total direct material cost variance. So we have three formulas for materials. So let's start off with our price variance. My price variance formula is your actual price less your standard price times your actual quantity, okay? So remember, standard amounts are what we forecast, what we anticipate, what we're guessing, okay? Based on their smart guesses as to what we think is going to be spent on these items, whether it be the materials or the labor. So these are estimates, okay? Actual is when they actually come in. When we actually manufacture the product, how long did it actually take us to make it? How much did we actually pay for the materials? You know, this is the real thing that happened. So we compare our estimates with our actual, and that is where we figure out the variance. Okay, and then we have to identify, well, why do we have a variance? What made us think that we were going to spend X amount when we actually came in much higher? Okay, so that is where the analysis portion comes in. Okay, so let's tackle the actual price variance. So if we look at the problem, let me go ahead and, okay, we have our actual price per pound right here, okay, 90 cents. So the actual price per pound of brass is 90 cents. Well, we had anticipated that we were going to spend how much a pound? We thought we were going to spend 80 cents a pound. Okay? So someone miscalculated. Something happened where we thought the price of the pound of brass was 80 and it actually came in at 90 cents. So let's go ahead and let's figure out our variance. So the actual price was 90 cents per pound. The standard, what we anticipated, was, let me put a dollar sign because this is dealing with money, okay? And then the standard was, we thought we were going to spend 80 cents per pound, okay? And then we're going to multiply times the actual quantity, okay? The actual, and we're going to look at the information, the actual pounds of brass used is given in the problem. It says right here, the actual pounds of brass used during the week is 4,500 pounds. Okay, so we're going to go ahead and we're going to multiply it by the actual quantity of brass used, which is 4,500 pounds. And then we're going to go ahead and we're going to calculate. Okay, 0.90 minus 0.80. And then we're going to multiply that by 4,500. And then that's going to give me 450 variance. Now, whenever the number is positive, this is important. When the number is positive, that means that we spend more than what we had anticipated, which is bad, okay? It is an unfavorable variance, okay? So, if the number is positive, when you enter your or put your formula and the number is positive, it is an unfavorable variance. And we can easily say it's an unfavorable because we paid 90 cents instead of 80 cents. So we paid more than what we had anticipated. Therefore, our variable will be unfavorable. Okay? That has to do with the price. We paid more than what we had anticipated. We're paying 90 cents versus 80. That's why we have an unfavorable variance. Now let's figure out the quantity variance. You know, this one deals with actual materials used, okay? Did we use what we said we were going to use? So we're going to start off with our actual quantity, okay? So the actual quantity, okay, is given. It's the actual number of pounds of brass used during the week is 4,500 pounds. So that is given, okay? And we're going to multiply by my standard quantity. Now, if you look on the top, the standard quantity is not given. We're going to have to calculate it. So I'm going to put a little formula down here. Okay. The problem stated that we produce 10,000 faucets per week. Okay. So based on that data, we're going to go ahead and get the 10,000 units. And we're going to multiply by how much brass do we need to manufacture the faucets. Well, for each faucet, my standard quantity of pounds of brass is 0.4. So let me get my calculator. So we've got 10,000 units that we're making a week, and according to my standard rates, I am going to use 0.4 pounds per unit. So that means that I'm going to have my standard quantity of 4,000 pounds. Okay. So the actual is given at 4,500. The standard we calculated down here at 4,000. So we're going to subtract the 4,000 pounds. Okay. And then I am going to multiply it by my standard price. Okay. Your standard price is 80 cents. Okay. So let's go ahead and let's do the formula. So we're going to have 4,500 minus 4,000 times 80 cents. Okay. And that gives me 400. Once again, the number is positive, which means this is an unfavorable variance. Okay. So why is it unfavorable? Well, the actual quantity that we used in materials came in higher than what we had anticipated. So we spend more materials than what we thought we were going to spend, causing an unfavorable variance. Okay. Once you have that calculated, then the third one is a piece of cake because you're going to get those two numbers that we calculated above to calculate your total direct material cost variance. Your total direct material cost variance is your direct materials price variance plus your direct materials quantity variance. Okay, so what we're going to do is we're going to get your 450 unfavorable variance, okay, plus your 400 unfavorable variance, okay. So if you get the 450 plus the 400, then you have $850 unfavorable. I cannot spell favorable today. Unfavorable. There we go. Okay. Now all of these are, let me go ahead and put them in dollar signs because this is dollar signs, okay? $450 unfavorable, $400 unfavorable, $850 unfavorable, okay? So we have an $850 unfavorable variance for materials, okay, for your total direct material cost variance, okay? So what does that mean? That means that we are spending more money than what we had anticipated in materials. So now the manager, the operations manager, whoever handles operations or dealings with materials, they're going to have to go back and analyze their data. Why are we unfavorable? Why are we spending more than what we are anticipating? Okay, is this something that can be fixed? Maybe we need to find another supplier of brass. Maybe our employees are new and they're taking longer than anticipated. What is going on that's causing these variances? Okay, so that is the first section. Now we're going to jump off to labor. The top section was dealing with materials, the price and the quantity. Now we're going to deal with the labor, the rate and the time. Okay, so let's do the direct labor rate variance. This is your actual rate per hour minus your standard rate per hour times your actual hours. And once again, those formulas are in your book right here. Okay, direct labor rate, direct labor time. So I don't want to hear it where miss, it's not in the book. Yes, it is. Okay. So let's go back and let's look at this section. So I'm going to have to be scrolling up and down. Okay. So the actual rate per hour. Okay. So now we're going to look at the rate per hour. Okay. So let's look at the actual rate per hour. And that is down here. So let me go ahead and highlight it. Okay. Actual wage per hour is $22. Okay. So $22 versus the standard rate per hour. Okay. And if we look at the data, their standard rate that we had calculated was $21. Okay. So why did we end up paying our employees $1 more? That's a $1 million question. I don't know. So my actual rate came in at $22 per hour. My standard rate was $21 an hour. Okay. And I'm going to multiply it by the actual hours. Okay. The actual hours is given to you right there in the problem. The actual hours is 1710. Okay. So the actual hours that came in were 1710. So we're going to multiply by 1710 hours. And let's see what we get. So 22 minus 21 times 1710. Let me go ahead and put equal sign. Okay, so that gives me 1710. Now the number is positive. If it's a positive number, that means it's an unfavorable variance. Now why is it unfavorable? Well, we ended up paying $22 an hour for our employees when we had anticipated we were going to pay $21. So that dollar per hour per employee adds up, okay? So now we have a labor rate variance because we ended up paying more than what we had anticipated, and it's unfavorable because what actually came in is higher than what we had forecasted. Now for the time variance, we're going to get our actual direct labor hours minus our standard direct labor hours, okay? And then we're going to multiply it by our standard rate per hour, okay? So let's go ahead and apply the formula. So we have our actual direct labor hours, okay? Our actual direct labor hours is given at 1710, okay? That is given. We're going to subtract our standard direct labor hours. Now, our standard direct labor hours is not given. We're going to have to calculate it. I'm going to calculate it down here. Now, for my standard direct labor hours, I'm going to get, the problem says that we are making 10,000 faucets per week. I'm going to get my 10,000 faucets, and it takes me 15 minutes, according to my standard labor rate, it takes me 15 minutes to make each faucet. So I'm going to multiply the number of faucets times the time it takes me to make the faucets, okay? So let's go ahead and do that. So we're going to have 10,000 units, which is what we're making a week, okay? And then we're going to multiply that by, it takes us 15 minutes. We're going to divide it by 60 minutes. Okay, that tells me that about 0.25, it takes me 0.25 of an hour to make each of the units. Okay, and if I do the math, let's see, let me get my calculator. I don't want to mess up. 15 divided by 60 gives me 0.25. I multiply it by 10,000 units. That gives me 2,500. So my standard direct labor hours are 2,500. Okay, and then I'm going to multiply it by my standard rate per hour. My standard rate per hour up here is, my standard wage per hour is $21, so we're going to go ahead and multiply it by 21. Okay, now let's do the math. 1710 minus 2,500 times 21. So now it gives me a negative amount, okay? If you get a negative amount, that means that it is a favorable variance, okay? So why is it favorable? Because the actual came in lower than the standard. We had anticipated spending 2,500 hours in labor. We ended up only spending 1,710 hours in labor. So we did good. We were very efficient in our time, causing a favorable variance, okay? So my rate was unfavorable, but my time variance is favorable, okay? So that means that my employees were efficient in making the product, and my numbers came in lower than what we had anticipated, okay? So now that we have these two calculated, we can calculate the total direct labor cost variance, which is basically the sum of those two, okay? So we're going to have 1,710 unfavorable plus 16,590 favorable. So if we put that in, that gives me 14,880. And because the number is negative, remember, if it's negative, we have a favorable variance, okay? A favorable variance. So our total direct labor cost variance is favorable. We spend less money than when we had anticipated in labor costs in total, okay? Yes, the rate was higher, but the time variance was lower. The net impact to my total direct labor cost variance is 14,880 favorable. Okay, so now we have a breakdown, and as managers, we are going to look at the areas that need improvement. Okay, we're going to analyze, we're going to make decisions, and we're going to be making adjustments to our standard rates. Okay, so that way we make sure that we are in alignment we analyze what actually came in versus what we had anticipated, and we adjust our numbers so we can be able to improve operations, efficiency, and save money in materials and in labor. Okay, so that is the problem. Very easy. It's just a matter of applying the formulas in the book. Okay, everything is in the book. So you just need to locate it, read the problem carefully. All of the information is provided. That way you know what is it that you're picking up. Okay, be careful when you're picking up your standard versus your actual. Okay, that's a common error that students make. Okay, so that is it for this problem. If you have any questions or concerns, please do not hesitate to contact me. Please look at the course syllabus for my scheduled office hours. And I hope you all have a wonderful week. Until next time, bye-bye.